Hello. Hey guys, welcome for Central Landing. That's an intro for hard money loans. My name is Mina. I'm an account executive here. Also have Jason, our sales director. We're gonna talk about hard money, how we can do hard money with the Central Landing. So, little bit about us as Central Landing. We are based in Florida, private lenders, and we service 4 states. We have products as bridge loans, rehab, fix and flip, construction, and DSCR. We did over 100 fix and flip and grounds up when we recently funded 2000 loan. By the numbers, that's the total 319 million total loan amount, 89 million active servicing per portfolio, and 37 million under management. So, unique value proposition for central lending that our fund manager approves your scenario upfront, and we fast close. So we close up as fast as 2 days, 2 business days, and we have in-house processing, closing, and construction draws. Our process for hard money and for central lending, technically, it's a very easy process and very quickly. We specialize in the fast closing for real estate investors. Understanding the hard money tool. Who use a hard money? They're usually real estate investors, flippers, BRR users, and builders. New entrepreneurs, limited credit history, or self-employed. Opportunities for buyer with tight timelines or distressed properties. And also repeat bros who needs fast, reliable capital without like hard money. Without hard time, or the hard money lenders, we will be able to help them. What's a hard money? Hard money is private loans based on the hard assets or the property. We don't really look at the documents for like your W-2s, your 1099, we don't look at full docs, but we look at the property itself and the documents for the property. It's used by investors for fix and flip, rental, and acquisition and new construction. It's usually faster and more flexible, little bit higher cost than banks, but it's faster and more flexible. When to use a hard money? We use a hard money for fix and flip, for rehab deals with strong margins and quick turnaround. Usually the loans start from 6 to 18 months. Bridge loans, short-term financing with no rehab budget. Construction loans for ground-up builds or heavy renovations. When the banks are slow, we usually close faster than the bank. And for a DSCR, where rent covers the payment and you need to close fast, and it's not like a regular conventional loan that you need a lot of documents and long process. Why hard money matters is as it's based lending based on the deal, not on your income or W-2 or full docs. It can unlock hidden deals, fund off market properties, distress, and urgent opportunities. Fuel fast closing, we close fast, reinvest quicker, and scale your business too. Should I use leverage in business? Yes or no? It will depend. So if you're gonna go two routes, either all cash or you're gonna use a hard money, you can see that total capital available for all cash is 400,000, but for hard money it's gonna be the same 400,000, but you're gonna use 200,000 per project for capital. But if you're gonna leverage the hard money as central lending, you will only use 50,000. So the profit per flip, it might be higher a little bit for all cash. Hard money, it come with its own expenses, but the both is gonna have the same time. But because you're using hard money, you can do 16 loans for the same amount of money instead of only 4 loans with just cash. Total profit is gonna be technically 4 times more than if you do just cash. So the return of investment, instead of 40%, you'll get it as 120%. The key limitation for all cash is you're gonna limit it with all cash. You can't really expand that or go further. It's only the cash that you have. The limitation with the hard money is that you're required to repay, like repayment plan, or you're required to pay interest on the loan. But again, you're gonna go way further with your money. Key benefits: no cost on capital, less risk. Hard money scales volume for higher profit. That's a graph you can see. If you start with your own cash, after 12 months, you will only be at 160. But if you use your own cash, same amount, and went with hard money in 12 months, you'll make 480. Choosing the right lender. There's different kind of private lenders, or like people who lend money to do real estate. So the private individual, they are usually the faster. They don't require as much documents, but they're also limited with the capital. They don't have unlimited amount of money. They don't have enough money. If you're working with someone and he decided to not do business with you, your whole business can stop. So that's the cons of working with a private lender. They might be quicker, but they can also change moods, and your business will be at risk because of that. As direct lenders, as central lending, so there is stable funding and correspondent lenders. As actual lenders, as central lending, we raise our own capital. We have our own funds. We have our own money. That's why we're the actual lender and the direct lender for the money that we use. We can work with brokers. What's good about that we don't have a cap for a broker. So we charge our fee, and you will add your fee on top as much as you want. As a broker, you're good to see as a borrower who seek a broker instead of a lender, it's good for him to go with a broker for like a challenging property, like a rural area, DSCR. or a place that no one else will find, a broker is very good to shop around for that. As banks usually have the lowest cost, but they have the longest time to get the loan from. They take a long time. They also borrow money like very cheap, so that's why they can lend cheaper. But you'll have to present a lot of more documents. You'll have also to present a lot of unnecessary documents. And if you want something quickly and fast and will get the job done, banks they're gonna take a while to close your deal. So for the process with us, we have the underwriting as the documents we need as a lender to get you the funds. We usually gonna check on the deal data. That's information about the underwriting collateral or the property. It's usually once per deal, and then we double check your entity that you're gonna use the deal like under it. As a hard money lender, as central lending, we need our deals to be done under an entity, not an individual. So you'll have to have an entity, and we have to have the papers like once per year. So if you did the project with us, if you did five, six, you don't have to present it every time. We can get it from like the previous deals, but we have to check it once per year. Same as the personal data. It's information about individuals behind the borrowing entity. So for the data that we do require for our contract or for our deal itself to get you the funds, we need to see a contract for a purchase. If you're gonna buy a property, we need to see like you have it already under contract. If it's a bridge loan and it's not a purchase, it's a quick refinance. That's other things we're gonna request. But as a contract, we need it for a purchase. As a rehab budget, we usually send you a template that has the rehab, and we need you to fill inside the amount of money that you're gonna use if you're gonna change the layout of the property. And look, with each amount of money that you're gonna use, there is an explanation of what you're gonna use the money for. Like if you're gonna do like a flooring, what kind of flooring you're gonna use. If you're gonna do like if you're gonna put appliances, what's the appliances you're gonna use. If you're gonna do paint, so just explain your project. That's gonna be in the rehab budget. And then we do request an appraisal. It's a property evaluation that make sure that your numbers are right and our numbers are right from a third party. It's not something we do in house. That's a third party. So for the appraisal, we request it, and then your loan will go into processing, and we will assign a processor. So that's a good like benchmark for us to know that you know your numbers, and we make sure that the numbers are right and it's a very viable offer. Like there is profit over there for you to make some money. Title work, we do request title work. You usually choose or pick your title, your agent, and we will request just the email address, the phone number, and then our processor will work with your title. Same as the insurance, we're gonna request a full insurance for the property. It's articles of organization. That's the articles we do request for your organization to make sure like everything is up to date. That's what we request once per year. If you keep doing business with us, it's gonna be the same, like on file. Same as operating agreement and signing consent. Mailing address, that's we use to make sure like your borrower or yourself, if you're an investor, that the mailing address, it's something you're not gonna live in the property, because it's our money is mainly based on the investment and is secured by the assets of the property. We don't want you like to go live in there and say you're an investor but you're living in there. You just want to make sure you have another place, not the property. EIN letter too, that's employment identification number. Driver license, that's as an ID. So we do pull soft credit and background check. We have a background check, so if anything we need to be aware of, we usually gonna need you to say that or request that before we go into the process, so we are aware of what's exactly is going on either in the background or in the credit. because once we pull the credit, it will depends on the leverage that we can give you for the loan. And the background, if there was like a bankruptcy like a year ago, we need to see an explanation. Or if there is something in the background, we're gonna need to see a letter of explanation of why that happened. Personal data is including the experience, so it's usually under the same entity or under the LLC that you're doing your business in. We're gonna need to see like how many deals you did. Let's say you said your experience, you did 7 deals last year, but only your personal data or your LLC shows 2. So we're gonna need to see if it's gonna match or not. Again, mailing address. We talked about that. What's our red flags for a hard money lender when like we get a loan? And these are stuff that we see, and it's either gonna see if we can get an exception or that's gonna be rejected. Majority of the red flags will be rejected, and that's some stuff to know from way further, like from the beginning of the process, so we don't waste anyone's time. So we have a bridge refinance. Uh, Bridge refinance is either like from bridge to bridge, like he had a property, it was with a hard money lender, he couldn't really fulfill it, and then he's doing another loan as a bridge. So the first deal usually failed, so that's another thing that's a red flag. Why did it fail? Why he couldn't pay off the property, and why he needs another bridge, not an extension with the current lender. The second kind of properties we really like have a red flag on is loans with the seasoned contract. That's you put the property under contract like in March, but you are getting a loan in like September. So that's a big gap between like the month, like the time you put it under contract and the time that you are searching for a loan with us. So why exactly is that's a big gap? It's usually because the lender kicked it, like the previous lender. If yes, so why did he kick it? What exactly he see in the property or he see in the documents that he decided I'm not gonna do that deal? Rapid high price appreciation. If the property, like you bought it for 100 and then after a year you want to do like a bridge loan or another like appraiser on it, and it came like 300 or 250 in a year. So these are like red flags. Why exactly the price appreciation went that much in this very little amount of time? Excessive wholesale markups. That a wholesaler usually they are the ones who get the distressed property or off-market properties, and once they get it, they add their fees. So there is loans that like it's a 400 purchase price, but the wholesale is like 25, 30,000. These are acceptable. But if the whole property is for 100,000 and then the wholesaler makes 70,000 out of it, that's a red flag. That's something we will suspicious of. We'll see what's going on. And entity gymnastics, that's usually when someone has multiple entity and then he buys properties under each one of entity. And usually this it's a good protection strategy, but it's also raise some red flags. Why is he doing all of that much? Is he's not confident enough with his entity or his strategy, or he will bail out, or he's not gonna pay his mortgage, or did he had anything in the past like bankruptcy and then he didn't pay his lenders? So these are things that we're gonna look at. Loan that takes 60 seconds to explain. These are usually like complicated loans that has a lot of ins and outs that no one really knows about. Like it's not like a fix and flip. I'm gonna buy it for X, I'm gonna rehab it for this amount, and that's my ARV, and that's my numbers, and the numbers make sense. So that's a good loan we will work on. But if you had to explain a lot and see like someone else said about that, and someone, then they came back with this, and then they came back with this, that's usually gonna make it as a red flag because there is a lot of stuff unhidden that we will know within the process, and it's just gonna be a lot of waste of time. credit box. So that's our leverage, that what we can use. It's a loan to cost. For investor, rehab is 92.5 and 100% rehab. Ground up and addition is 85%. Bridge is 80%. So that will depend on multiple factors. One of them is the credit. So if you have high credit, like over 700, you will get the maximum LTC regarding this part. If you combine it with experience adjustment, your high experience, or you have 3 to 5 experience in the past 2 years, will also give you the highest leverage. For ground up, it's gonna be the same. If you did 3 in the past 2 years, we're not gonna deduct from the loan to cost or from the leverage. If you did 1 to 2, it's gonna be, instead of like 85, it's gonna be 82.5. If you didn't do any, it's gonna just be 80. And then deal-based adjustment, that will be based on the property itself, or like the condition. That's what we are aware. Rural properties, we will deduct 5% or 10%. If it's in Philly, we will did like Baltimore and these areas, we will deduct 5%. If it's 5 to 10 units, we will deduct 5%. If he's foreign investor, we'll deduct 5. If it's refinance, 5. If it's over 750,000, we'll deduct 2.5%. So as an example, if someone is 680 score and who's also like 1 to 2 experience, and let's say he's not over here. So instead of 92.5, we'll deduct 2.5, and then we will be at the maximum of like 90%. If the 90% was, the property was like rural property, it will depend. If it's partially rural, we'll deduct another 5. If it's very rural, it's gonna be 10%. If it's not, you will have like 90% loan to cost loan. Other metrics that we look at is the credit score, credit and background events. If something happened in the background, the credit just dropped dramatically, we're gonna see why exactly that happened. The borrower experience, we talked about that. If you have experience in the past 2 years, that's including total rental owned. So we count it as points, like from 1 to 2, that's a beginner. From 3 to 5, that's a mid experienced investor. From up to 5, more than 5, 6 or plus, that's a high tier investor. And that can be from, we will count as total rentals he owned, how many he owns, and how many fix and flip he did in the past 2 years, how many grounds up he did in the past 2 years. And we'll also check local market experience. If he has experience in this market, let's say someone in Florida, in Tampa, and he's doing deals in Tampa. So that means he has a lot of local market experience, that he can get some exceptions that he can explain to us, like a business explanation in the exceptions, and we will agree on. Compared to someone in Texas and he's doing a deal in Florida, but he never been in Florida or never done any deal in Florida. That's gonna be a little different. Renovation ratio. We also gonna check if you're gonna dump like 150,000 on renovation for 20,000 property. If yes, we're gonna need to explanation why exactly that's gonna happen. Why do you want to dump 150? What's the ARV, or what's the explanation you want to do that? And source of the down payment value compared to median values. Source of down payment is important. We need to see that you usually have liquidity, enough liquidity, and it's like your money. You're not gonna ask your friend for some money. He's gonna give you some money, and then you will be okay, I will do the deal because I have the money, but it's not your money technically. You borrowed the money, so we won't be able to help you with that. We need to see that you have your own money, and that can be as a cash or credit cards, or even a HELOC, line of equity from your home, or 50% of your stocks. And that's the borrower liquidity. Deal profitability, we need to see that the deal, there is some money you will make at the end of the deal. It's not you will just do the deal to break even. Like That's not a reasonable business. So you have to see that you will make some money for the deal. Loan flow chart. How exactly the process in central lending is gonna work is you will request a loan. We'll submit a term sheet. We'll give you a term sheet. Let's say you either agree on it or you withdraw. It's not gonna work. You agree on it on the term sheet. You want to proceed. If it's a purchase, we will ask for the contract, and of course we will ask for the title information and the insurance, and we'll order appraisal. Once you pay for appraisal, we'll assign a processor, and then the processor will start to collect the documents. So it has to be here. That's our management team will look at the loan and see if there is something missing or everything we have, like the title, the contract, and the insurance, everything makes sense. The deal is profitable, and we agreed on the terms, so we will move it to qualify. If not, it will be declined. Once we move it to qualified, we assign a processor that they will collect the documents. We will ask for the documents, but if the documents are not provided or if something is wrong, it's either we will go back, and if the management, like because of the red flags that we talked about, pop up and something is wrong with the loan will be declined. But if everything we spoke about is the same, like what we talked about before, submitting a loan is the same as after, so it's gonna be the same. So the loan will be approved and we'll move forward. Data approved and move and loan closed. So our processor will request some document. There is some sheets for each kind of loan we're gonna send to you, and each one of them, once you submit the documents, we will review it. And again, if everything was as we talked about, so the loan will be approved. It's not that we're just gonna push you to put the loan and then we'll decide. No, the loan will be approved as long as everything we talked about is the same. Common mistakes. They don't have, for investors, they don't have enough liquidity. They come back asking for 100%, like 100% loan to cost, and everything. They don't want to put any money. Usually they don't have enough money, but if they do have enough money but they don't want to use their money, these are kind of borrowers that we like to deal with. And these are the kind of borrowers that usually will get the highest leverage and best rates from us too. They don't have an accurate rehab budgeting. They don't know exactly the rehab cost, or they assume it's something and then it's completely different. They don't really understand the true cost for a hard money, or for working with a hard money, or even the real cost of doing a fix and flip using a third party comps. So, like a wholesaler who provided the comps, and as an investor, you don't really do your due diligence and check the comps, but you go right away with the wholesaler said, and sometimes it's wrong, sometimes it's right, but the majority of the time it might be wrong. So when you, like as an investor, we need to see that you did your own due diligence and you already know your numbers are right. You're not just counting on other people numbers. Choosing wrong lender for deal type. So common mistakes for choosing a wrong lender for deal type. Some, like, if you want fast close, you want something that's quickly, you want something that's gonna make you be able to do more deals in a year. So go with the hard money, because we can close quickly. I think our CEO last Monday closed the deal in a day, one day, because he already have the information and all the docs from the other borrowers, and he just went straight ahead and approved it. So we can close quickly as that's at that quickly. But if you want something with the cheapest rate ever, something that you're not in a hurry to close, something will take a couple of months to close. So it's usually a bank, and a bank, they were not gonna lend you for as the hard money. How they gonna lend you? So that's the difference. So deal or no deal? Now we see that. Hi, sorry Courtney, I just saw your comment. So borrower has 590 credit. Okay, let's go back to here. So 590 and two flips. So we will deduct 20% of the 92 and a half. So it's gonna be around 72.5% for him. But again, we will have to double check again for what's exactly the exact metric. I can send you a size or two to see the exact numbers so you can even like size your own deal. Um, yeah, I will double check exactly the exact percentage, but it can be around 72.5%. Awesome, you're welcome. Okay, guys, do you have any other questions for me? Okay, it seems no. So thank you guys for coming today. Really appreciate every one of you. And Courtney, I'm gonna send you a sizer, and we can talk about this loan like afterwards. Thank you. Thank you, Michael.